December 8, 2005. The Tokyo Stock Exchange opens to a wave of anticipation. A new staffing company, JCOM Holdings, has just gone public, and traders are ready for another high-flying initial public offering. The room hums with noise as orders stream in. Then, in an instant, everything changes. On the ticker, a sell order appears that makes no sense. 610,000 shares, priced at just 1 yen each. But JCOM only has 14,000 shares outstanding. It's not possible. At Mizuho Securities, a clerk has entered a catastrophic error. He was supposed to sell 1 share at 610,000 yen. Instead, he is offered the entire company at a price near zero. The system accepts it. The stock collapses. On the floor, traders are paralyzed. Some think it's a fraud. Others expect the exchange to cancel it. No one dares step into the chaos. Millions of yen vanish in seconds. But miles away, in a small Tokyo apartment, a 27-year-old sits in pajamas, staring at 4 glowing monitors. The desk is messy. A half-eaten cup of ramen sits next to the keyboard. Stacks of manga line the floor. He doesn't hesitate. He starts clicking. Buy, buy, buy. By the close of trading, he controls nearly half the company. The next morning, as Mizuho scrambles to contain the disaster, the price rockets upward. When the dust settles, his profit is 2 billion yen, $17 million, made in a single day. And from that moment, one name followed him everywhere: the JCOM man, Japan's most legendary day trader. To understand the JCOM man, we have to rewind almost 2 decades, to Osaka in 1986. Takashi Kotegawa was born into a Japan very different from the one his parents knew. The country had spent the 1980s riding the most powerful asset bubble in modern history. Land prices were so inflated that the Imperial Palace in Tokyo was said to be worth more than all the land in California combined. Stocks soared, confidence seemed limitless, but by the time Kotegawa was old enough to understand the world around him, that illusion had already collapsed. In the early 1990s, Japan's bubble burst. Real estate lost more than 60% of its value. The Nikkei stock index, once the pride of the nation, fell from 39,000 points in 1989 to barely half that within a few years. The crash ushered in what became known as the lost decade. 10 years of stagnation, deflation, and despair. A generation that grew up in those years came to see the markets not as places of opportunities, but as symbols of ruin. Kotegawa was not a typical child. While his peers played outside, he preferred to stay indoors. His room was filled with manga, anime, and video games. He spent hours in front of screens, absorbed in patterns and details that most ignored. Quiet, withdrawn, and methodical, he grew up comfortable in isolation. Those traits would later become his greatest weapons. By the late 1990s, he entered college. Life was simple, almost austere. He supported himself with part-time jobs, often working nights and weekends. His meals were instant ramen, his luxuries few. Most of his energy went into long hours alone in his dorm room, where, by chance, he stumbled onto the idea that would change his life. In 1998, Japan's national broadcaster, NHK, aired a 4-part documentary series about global finance. The first episode, titled The Man Who Lost 50 Million, profiled American hedge fund manager Victor Niederhofer. Niederhofer had built an empire trading derivatives, but he was equally famous for losing it all, more than once. His recklessness, his rise and collapse, and the sheer danger of his world captivated viewers. For most, it was a cautionary tale. For Kotegawa, it was inspiration. He saw in Niederhofer's story something entirely new: the possibility of freedom. A man with nothing but a screen, a strategy, and the nerve to risk it all could make or lose millions. From that night forward, Kotegawa decided he would become a trader. But ambition wasn't enough. He had no mentors, no teachers, and in Japan at that time, virtually no textbooks or guides on day trading. The market was a closed world, dominated by institutions. A college student had little chance of breaking in. But Kotegawa approached the problem the only way he knew how: through patience and discipline. He took every part-time job he could find, saving relentlessly. Rent was covered, food was kept cheap, and every other yen was set aside for trading capital. In between work and classes, he spent hours studying price charts of the Nikkei and its leading companies. He tracked their movements daily, looking for patterns, teaching himself what no book could explain. For 2 years, this was his life. Work, ramen, charts, sleep. By the year 2000, he had finally scraped together $16,000. It wasn't much, not compared to the billions that move through Japan's markets every day. But for Kotegawa, it was enough to take his first steps into the game that would define him. What he didn't know was that the world he was about to enter was one of the harshest market environments in modern history. The dot-com bubble had just burst, the global economy was sliding into a downturn, and Japan, still scarred from its own collapse in the 1990s, was about to face another storm. For most traders, it was a graveyard. For Kotegawa, it would be the proving ground that turned a broke college student into a legend. When Kotegawa finally stepped into the market in 2000, the timing could not have been worse. The dot-com bubble had just imploded, sending global stocks into collapse. In Japan, the scars of the lost decade were still open. The Nikkei was bleeding value. Fear dominated every trade. For a first-time investor, it was like walking into a fire. Armed with $16,000 and little more than his self-taught knowledge of price charts, Kotegawa began making his first trades. Almost immediately, the losses came. His small account shrank with every mistake. For most newcomers, this would have been the end, but Kotegawa treated the pain differently. Every failed trade became data. Every loss became material to study. Night after night, he dissected what had gone wrong, and slowly, he discovered something consistent. In bear markets, panic pushes prices far below their averages. Investors sell too quickly, overshooting reality. And when that panic exhausts itself, rebounds follow. Kotegawa began building rules around this pattern. He tracked the 25-day moving average of Japanese stocks and waited for sharp deviations. When a stock fell more than 20% below it, sometimes 30 or more, he would step in and buy. When the rebound came, he sold quickly. It was mechanical, disciplined, and grounded in observable behavior rather than theory. But he didn't stop there. As his experience grew, he realized that not all sectors behaved the same way. Service companies, tech stocks, and emerging industries each had different thresholds for panic and recovery. By cataloging these differences, he tailored his entries with greater precision. What looked like chaos to others became a map for him. By the end of 2002, his approach had transformed his account. $16,000 had grown into more than $1 million. The anonymous college student eating cup noodles in a cramped Tokyo room had become one of Japan's most effective day traders. On online forums like 2channel, his posts were studied and debated, his trades dissected. A myth was beginning to form around his name. But his success had been forged entirely in crisis. His methods thrived on fear, on markets collapsing into extremes. And as Japan shifted toward recovery and optimism returned, Kotegawa faced a new challenge. The bear market was ending. The rules that had made him a millionaire were about to stop working. By 2003, Japan's market was no longer defined by fear. After a decade of stagnation and collapse, confidence was slowly returning. The Nikkei 225, which had bled value for years, began to climb again. Investors who had once fled were now rushing back in. For Kotegawa, this was unfamiliar territory. He had mastered a system that thrived on panic and overselling. But in a market where prices rose steadily, his contrarian methods gave him fewer signals. The easy rebounds were gone. Rather than abandon discipline, he started over. He spent months analyzing the new rhythm of the market. What he noticed was subtle but consistent. When the index moved upward, large companies almost always followed, but not simultaneously. Some stocks reacted first, rising sharply with the momentum. Others lagged behind, moving days or even weeks later. To most traders, this delay looked random, but to Kotegawa, it was an opportunity. He built a new framework. Instead of hunting for collapsing stocks, he hunted for companies that were slow to respond to bullish sentiment. If the index was climbing and a core stock had yet to catch up, he would buy. When the lag finally closed and the stock aligned with the broader move, he sold. It was less dramatic than his bear market trades, but it was reliable. The change reshaped his daily routine. In the bear years, he had executed trades constantly, chasing rebounds as they appeared. Now he often waited days, sometimes weeks, for the right setup. His focus shifted from volume to precision. Each trade carried more weight, and each position was held longer. The patience he had built as a student now became his greatest advantage. The results were staggering. Over the next 2 years, his account expanded into 8 figures. By the mid-2000s, Kotegawa was one of the wealthiest independent traders in Japan. Yet outside the market, his life looked nothing like the balance in his account. He still lived in a small apartment in Tokyo. His diet remained instant noodles and cheap food from the corner store. The floor around his desk was stacked with manga. His walls were bare. His furniture was sparse. The millions he had made were invisible, locked away in brokerage accounts rather than spent on lifestyle. This wasn't frugality out of necessity. It was a conscious choice. Kotegawa had no interest in cars, travel, or luxury. Money, to him, was only a tool to keep playing the game. The act of trading, reading the market, anticipating its moves, and executing at the right moment was the only thing that mattered. Everything else was a distraction. But while he remained hidden, his presence on online trading forums was growing. Anonymous posts dissecting market moves began to mention him. Rumors circulated about a mysterious trader making millions from a small apartment, someone who ignored the rules of the professional world and won anyway. To retail investors trapped in a system dominated by institutions, he was proof that it was possible to beat the game. By 2005, he had built not just wealth, but also a reputation, even if most of Japan still didn't know his name. And that December, a single mistake from one of the country's largest security firms would bring him out of anonymity forever. December 8, 2005. The Tokyo Stock Exchange is alive with anticipation. JCOM Holdings, a new staffing company, is making its debut. Traders crowd their screens, watching the first ticks of the stock's price. For most, it's just another IPO in a market that has seen dozens that year. Then, it happens. At Mizuho Securities, an employee enters an order meant to sell a single share of JCOM at 610,000 yen. Instead, he enters 610,000 shares at 1 yen each. The mistake is catastrophic. JCOM doesn't even have that many shares outstanding, but the system accepts the order anyway. Within seconds, the stock collapses. The trading floor erupts in confusion. Brokers can't believe what they're seeing. Some assume it's fraud. Others think the exchange will reverse it. But no one wants to take the risk. They freeze, watching millions of yen evaporate in front of them. In a small Tokyo apartment, Takashi Kotegawa sees the same numbers. 4 monitors glow in the dark. He doesn't hesitate. He clicks buy. Over and over, thousands of shares pour into his account. By the time the closing bell rings, he controls more than 7,000 shares, nearly half the company. For most traders, the pressure would be unbearable. Half of his net worth is tied up in a single trade created by a clerical error. If the exchange cancels it, his fortune vanishes. If institutions force a reversal, he could be ruined. But Kotegawa is calm. He holds through the night. The next morning, Mizuho Securities scrambles to contain the disaster. They plead with the exchange to cancel the order, but the rules forbid it. Desperate, they begin buying back shares at whatever price they can. Institutional players join in, eager to profit from the chaos. The price rockets skyward. Kotegawa sells slowly, unloading pieces of his position while holding thousands of shares in reserve. By the time the dust settles, the outcome is clear. He has made 2 billion yen, $17 million, in a single trade. It is one of the most extraordinary wins in the history of Japanese markets. The media seizes on the story. Newspapers call him the JCOM man. Trading forums elevate him to near mythical status. Even Masayoshi Son, Japan's billionaire founder of SoftBank, is said to be fascinated by him. In a country where trading was dominated by institutions, a lone man in pajamas had just humiliated the system. But while Japan celebrated its newest financial celebrity, Kotegawa wanted nothing to do with fame. He declined interviews, refused public appearances, and kept living in his small apartment. For him, it was not about money or recognition. It was about the market, the game itself. Still, the JCOM trade changed everything. He was no longer just a skilled trader hiding in anonymity. He was a national legend, a man whose name had become synonymous with beating the system. And soon, the markets would test him again, this time on a scale larger than anything he had faced before. October 2008. The global financial system was unraveling. In the United States, banks were collapsing under the weight of bad debt. In Japan, the news dominated headlines, but the crisis felt distant until Lehman Brothers, the fourth largest investment bank in America, teetered on the edge of failure. To Kotegawa, Lehman looked like an opportunity. Its stock had already fallen by 73% that year. To him, the numbers resembled the same extreme deviations that had fueled his rise in Japan. He believed the panic had gone too far. Lehman, with its long history and reputation, seemed certain to rebound. He went in with size, $6.5 million, a massive bet even for him. But this time, the setup betrayed him. Within days, Lehman Brothers declared bankruptcy. The stock collapsed to zero. His entire position was wiped out. Overnight, he had lost millions. It was the first time his discipline had failed him in such a spectacular way. He had broken his own rule: never trade what you don't know. He had mastered the Japanese markets, studied their behavior for years, and built systems tailored to their rhythms. But in the US, he was an outsider. The corruption, the systemic fragility, the hidden risks, none of it showed up in the charts he trusted. But the collapse of Lehman was only the beginning. What followed was the most violent bear market since the Great Depression. The U.S. housing crisis spread like wildfire, pulling down economies across the globe. Japan, heavily dependent on exports, was hit especially hard. The Nikkei had collapsed below 7,000 points, its lowest level in more than 2 decades. For Kotegawa, it was both a nightmare and an opportunity. The exact kind of environment that had turned a college student with $16,000 into a millionaire had returned. But now, the stakes were far higher. He studies the charts the way he had years earlier as a college student, looking for signs of exhaustion in the panic. He recalculates his rules, updating the deviation targets he had used in the early 2000s. Markets had grown faster, rebounds happened quicker, and he knew his old thresholds were no longer valid. With precision, he adjusts each sector, searching for the exact points where fear turned into opportunity. On October 27th, as the Nikkei sinks further, Kotegawa moves in. He begins buying positions across dozens of companies, spreading risk but keeping exposure large. His account swells with orders until his total stake reaches nearly $65 million, spread across 90 different stocks. For any other trader, the weight of such position would be unbearable. But Kotegawa is calm. He has been here before. That afternoon, a few of the largest companies begin to rally. At first, it's a flicker. Then momentum builds. By the close, the entire index is climbing. The next morning, the rally accelerates. As the Nikkei recovers, a chain reaction spreads across the positions in his account. One by one, the companies he bought begin to rebound. Kotegawa starts to sell. Carefully, piece by piece, he unloads his positions into strength. By the time the dust settles, the trade has earned him more than $12 million. In a single move, he restores the confidence that had been shaken by Lehman. On trading forums, the myth of the JCOM man is revived. Stories of his massive positions circulate like urban legends. While institutions lose billions in the chaos, a solitary man in a Tokyo apartment once again walks away with millions. But this time, Kotegawa doesn't celebrate. The win confirms what he already knows. The market will never stop testing him. The crash has left scars on economies everywhere, and Japan's dependence on exports means the pain will linger. For him, the lesson is clear: adapt or die. And so, even at the height of victory, he begins preparing for whatever comes next. In the years after the financial crisis, Kotegawa did something unexpected. While many believed he would turn his success into a public empire, launch a hedge fund, manage outside money, or step onto the global stage, he chose silence. He diversified. Quietly, he purchased 2 commercial buildings in Akihabara, Tokyo's electronics and anime district. The deals were made in cash. The tenants were steady, the rental income predictable. For a man who had built his fortune in some of the most chaotic markets in history, real estate was safety, a way to lock in wealth without exposing himself to daily volatility. Years later, he sold one of those buildings for a profit of billions of yen, having collected rent the entire time. But even with this shift, his heart never left trading. He continued to operate from the same kind of setup he had always preferred: a desk, a cluster of monitors, a quiet room. He avoided interviews, refused publicity, and never tried to build a brand around his name. In an era when finance was becoming more global, more digital, more personality-driven, Kotegawa remained invisible. For those who followed him, this disappearance only deepened the myth. Was he still trading? Was he managing a private fortune? Or had he walked away entirely? Even today, his fortune is estimated in the hundreds of millions. Some believe he could already be a billionaire if all of his assets were counted. Yet almost nothing is known about his personal life. There are whispers that he has a family, that he has chosen a quieter existence, far removed from the chaos of markets. Takashi Kotegawa never sought to become a symbol, but in the history of Japanese markets, he is remembered as the man in pajamas with discipline and focus who could rewrite the game.